Welcome to part 2 of week 2's personal finance notes. This section is going to be on paying taxes. And as you probably know, there are a lot of different kinds of taxes. So we'll talk a little bit about them and then a little bit more focused on income taxes. So this is not a comprehensive list, but it's a pretty good list of some of the taxes that people pay in the United States. There's the federal personal income tax, and we'll look at a tax table for that in a moment. There are also, most states have a state personal income tax. Not all states do, and that's something that that'll be on the Quiz Bowl list. Something to know is different states that do not charge personal income tax. Many states have a state sales tax. Minnesota has state sales tax, but we have exemptions for food and clothing. So if you buy food that is like at the grocery store, like you buy apples, you do not have to pay sales tax on them, and also not on clothing. But other states do charge sales tax on food and clothing. We have 2 FICA taxes, and we'll look at those rates a little bit later. Those are the taxes we pay for Social Security and Medicare. They're also paid on our income. And then we have the property tax, which is generally paid to support schools and local government, and that is paid as a percentage of the value of your home as your home is assessed. The estate tax, and then there's a separate tax called the death tax that are both paid when a person dies. The estate tax is levied against the value of your estate. Capital gains tax is also a portion of the income tax with a different rate, and we will look at that one. And then license fees, things like buying a license plate for your car, is actually a form of a tax as well. So the main federal tax that people pay is the federal personal income tax and the capital gains tax. And then we also pay FICA and Medicare, which are smaller amounts. The main state tax that we pay in Minnesota, we pay a state personal income tax and state sales taxes. And then locally, we pay property tax. There can also be local sales taxes, and there can also be federal sales taxes. So there's a lot of different ways it breaks down that different governmental organizations get part of your money for paying for public goods or quasi-public goods like roads and bridges. You probably remember from economics class about the types of taxation. Those are defined based on the relationship between what you pay and your income. Okay, so it's relative to your income. So proportional tax is where everybody pays the same percentage of their income. And there really isn't a proportional tax, but FICA is proportional, at least to the extent up to the cap. Okay, so everybody pays the same percentage until the cap, and then it becomes regressive. Our income tax, our federal income tax, is the best example of a progressive tax, and you'll see the tax brackets in a minute. As your income goes up, you pay a higher percentage. And then a regressive tax, the sales tax is regressive because people who are in higher incomes tend to save more. They don't spend every dollar on consumption, and therefore they end up spending a lower percentage of their income on the sales tax. Okay, these are the tax brackets for 2015, so when people are filling out their tax returns in 2016, this is the way taxes will be calculated. So you can see this is a progressive income tax because people pay higher marginal tax rates on higher amounts of income. So if your income is between 0 and 9,225, you pay 10%. Okay, your tax is actually just 10%. It's a flat rate. But if you earn additional money, let's say you earn $35,000 a year, you would pay the 10% of your first 9,225. So you can see that is right $922.50. And then you pay 15% on the rest. So 15% is the marginal tax rate for somebody in that bracket. They pay 15% on the essentially about whatever it is, $26,000 that they've earned above $9,000. So take a minute and calculate it. If your taxable income is $100,000, what is your tax? Pause so you can calculate it. If you came up with $21,071 approximately, okay, that would be about the right amount. So you would have to figure out, you would see very quickly that somebody with an income of $100,000 fits into this bracket. So they would pay $18,481.25, and then you would calculate 28% of their remaining income. Okay, and that's what would give you their total tax bill. Okay, capital gains. You probably know that capital gains tax rates are lower. People do pay capital gains tax as part of their income tax. But if you, for example, fall into the 25% tax bracket for your income tax because you are, and this is, I'm just using the tax brackets in both cases for single people. I'm not looking at married couples or married couples filing separately. So if your income is, between $37,000 and $90,000, and you're paying a marginal tax rate of 25%, your qualified dividends and long-term capital gains rate will be 15%. So you pay a much lower rate on capital gains. And you can see that at the lower levels of income, people with capital gains pay nothing, all the way up to over $400,000 a year. The capital gains rate is 15%, and it's only on the highest income earners who are paying almost 40% on their ordinary income. They pay only 20% on capital gains. So capital gains taxes are paid if you, say, own stock, sell the stock, and you make a gain, meaning that you sell it for a lot more than you bought it for. That's what you pay this 15% or 20% tax rate on. So a lot of people who get paid in stock options, for example, their income would be classified as capital gains. Okay, as I said, I'd come back to FICA. This is Social Security and Medicare. And Social Security, you pay 6.2% rate on the first $118,500 of your wages. And typically you pay half and your employer pays half. So you actually see that contribution on your payroll statement or on your paycheck from your employer. And then you also pay 1.45% for Medicare, and that's on the first $200,000. And above $200,000, you pay 2.35%. So the Medicare tax is actually slightly progressive, but Social Security is a proportional tax for the first $118,500, and then it becomes regressive because people with higher incomes do not pay more into Social Security. All right, when we've been talking about the tax rates, we've been talking about the tax rates on your taxable income, and it is important to know that your taxable income is different from both your gross income and your disposable income. So your gross income is what your employer agrees to pay you. I'll pay you $75,000 a year. You don't pay tax on that whole entire $75,000 a year. So before you calculate your taxable income, you get to subtract for exemptions. So for example, you get a personal exemption of $4,000, and if you have a dependent, like a minor child, you get to subtract another $4,000 for them. So if you have a family of 5 dependent on one income, you take $20,000 off the top for your exemptions. When you get a job, you list all of your dependents on your W-4 form that you fill out for your employer. And so they know how much to deduct from your paycheck each time to put toward your taxes and how much to actually pay to the government. Okay. After your exemptions, you also have deductions, and these are adjustments that you can make to your gross income for specific expenses. So you might be able to deduct for medical bills or charitable donations or spending on education. So if your parents are paying for $200 for the school bus, you can deduct that. Property and income taxes. Losses, you pay for capital gains, but you get actually a deduction for capital losses. You can even deduct for gambling losses. If you don't want to what's called itemize your deductions, because it can be very time consuming to keep track of all this stuff, if you don't want to do that, you can take what's called the standard deduction. There's a certain dollar amount that the IRS lets you just take as a deduction from your gross income each year. Also, you can get something called tax credits, and those, after you've calculated your whole tax bill, maybe you figure out you owe $20,000, but you did some home efficiency improvements, you put in new windows in your house, and you can deduct $3,000 straight off your tax bill as a tax credit. So tax credits are a great savings to people. First-time home buyers get a tax credit. When George Bush was president, he put in place a child tax credit, so parents got to take a bunch of money off just because they had kids. You can take a tax credit for child care. So there's a number of things that you can actually just take straight off the top of your tax bill. And a few other names of tax forms. The W-4 is a form that you fill out for your employer that tells the employer how many exemptions you're going to claim. And if you want extra withholding, if you want them to keep more of your money, you can also do that. The W-2 is the form that any employer that you work for, basically a full-time employer, is going to send you a W-2 form, and they have to send it legally by the end of January, and it tells exactly how much you earned from them and how much they paid in your taxes during the year, and so forth. A W-9 is a form you fill out for contract work, so let's say you agree to write an econ lesson for a particular organization. You fill out a W-9, that includes your Social Security number, and that means that they will report to the government what they paid you, but they don't withhold money for your taxes. And then when you fill out a W-9 in January of the next year, you get a 1099. So you get a form that says, here's how much this organization paid you. And you're, of course, legally obligated to report that income to the federal and state governments. And that is the end of our section on taxes.